And I tell my wife that the mid-year recap is this: you haven't lost any money because you haven't sold anything.
That's right. Don't lock in your losses.
Yeah.
Hold on. It'll be all right. All right, it's noon. I'm going to make sure that Valerie can you hear me? Good. Turn on the mic. So thank you all for coming. I'm Nate Zeller. I'm the Chief Investment Strategist here. Been with Security Retirement a little over a year. Been in the industry a little over 20 years too. Thought we would go through a mid-year recap, kind of look at what happened the first half of the year, and also more of the second half outlook. I think most of you are aware of what happened in the first half, so I don't want to dwell a lot on that. It was pretty bad. I about did something called the good, the bad, and the ugly, but I couldn't come up with anything good, so figured we would go with this. And I want this to be very interactive too, so if any of you have thoughts, questions, don't hesitate to interrupt me. Obviously, there's some time at the end. I have a lot of slides in here today, a lot of graphs. Hopefully, I don't bore some of you. So some of these I'm going to kind of touch on and keep going. I should be able to get through all of them in the next 2.5 to 3 hours, so don't sweat it. It's I'm just kidding, of course. Do need to start with our usual disclaimers. This is not construed to be individual investment advice. These are opinions, a lot of speculation, predictions in here, so it may or may not happen. That kind of how we view the markets as of today, our outlook going through the rest of the year. And like I said, we want to start out, talk a little bit about what happened in the first half of the year, then get in and talk about more of what we're looking at second half of the year and even getting into the early part of 2023 and beyond at this point. Because like we'll see, things are always subject to change. This is how I'd characterize 2022 so far. Somebody, I don't know who this is. I'm sure the kid's all right, fell in the grass. Kind of similar to the stock market. If you haven't sold yet, you should be all right. So just hang on. It was a difficult year. This is stolen out of a Fortune magazine article, but I think they're okay if I use it. Really, nothing did well in the first half of this year, as I'm sure you're aware. The S&P 500, this would be as of the end of June, so the first half was down 21%, putting it into what we call bear market territory, which is whenever the market's down 20% or more. At its low point in June, it actually was down about 24%. It recovered a little bit. July's been a good month for the market. The S&P's up 5% or so, give or take. The NASDAQ's up 7% or so, give or take. We can get into that a little bit more in a second. Maybe I just need to turn this on. No, still not working. All right. Did I skip one? Yeah. So then looking at the individual S&P sectors, and this is probably not real surprising. Energy did very well. Everybody's aware of what energy prices have done. Even if you have an electric car, you drive by the gas station, see those gas prices. For those of us with fuel engines, internal combustion, we have to stop and pay out a lot of money, take out a second mortgage and fill up the car and keep going. Utilities did comparatively well, very steady, a lot of utility companies. Some of those are natural gas companies too. Again, paying your home heating and cooling bills.
They're taking their lack of investment in Texas out on us.
I think so, and they seem to be doing all right. Consumer staples, so those are the types of things that really you need. Detergent, toothpaste, Clorox wipes are examples of staples. They did relatively well. Healthcare always seems to do all right no matter what the market's doing. Again, it's all relative. It's still, in most years, if you said, hey, my portfolio was down 7%, you'd be pretty upset. But when the whole market's down 20%, 7% is relatively well. Materials had done fairly well. That's generally a very inflation-proof type of investment. But commodities, the commodity complex really fell apart in June. And we can talk about that a little bit too. We've seen a lot of commodity prices drop rather significantly here in the past month. So materials were doing well, and then right towards the end of the second quarter, they really dropped off. I think a couple of surprises were financials and real estate. Real estate's always kind of thought to be a very inflation-proof type investment. There's a lot going on with higher interest rates. Has made it very difficult. Real estate's very I'm saying it includes office buildings. There's a lot of people through the pandemic that are no longer working in an office and are now able to work from home. So office buildings have struggled. Retail seems up and down. I think that's very specific. Some retail locations have not done well, while others have continued to thrive. And then financials are a bit of a surprise. Generally, as interest rates move up, there's a higher net interest margin to be earned there. And we would expect financials to do well in a rising rate environment, but what's happened is that there was a lot of fear over a recession, slowing economy, putting a lot of pressure on the financial stocks. Little different chart, kind of the same thing. This line right here is the zero, so everything to the left is zero, had a negative return. The reason I point this out is it includes a lot of the bond indices. Bonds had a horrible, I think one of the very worst first half of the year in history. I saw a stat that said something, don't quote me on this, that 30-year Treasury had its worst year since 1778 when George Washington first directed the National Bank. I'm butchering this story, but it was a very difficult first half of the year for bonds. As interest rates moved up, bond prices moved lower. And so we look at a 60-40 portfolio, which is kind of just a standard blend that people traditionally have done. 60% stock, here we use the SP, excuse me, 500 is our stock proxy, and the 40% Bloomberg Barclays Ag is our bond, and you can see it's the very worst, going back to 1976, I'm sure you could look back further and there's other bad years. That portfolio that was supposed to be relatively safe did pretty poorly, with the bond aggregate being down. The Bloomberg Barclays Ag was down about 10% the first half of the year. Longer dated treasuries, like your 30-year, anything over 20 years was down 20 to 23%. So fixed income did not provide the diversification that it traditionally has in the past, which really is no surprise because interest rates were so low. They're, again, it's the teeter-totter, and we'll talk more about this in a second. Interest rates were so low, they couldn't go any lower, so they moved up, especially in face of inflation, and bonds did poorly. Some of you, I see a lot of familiar faces, of course, and thank you for being here. Many of you were here at the beginning of the year when I made some predictions. This is one. I said the stock market will have another positive year. It's looking doubtful at this point, but it's still not out of the question, so I don't know. I want to own up to some of the things that I said earlier. This is reviews. I don't know. I mean, July's been a good month. We could bounce. I'm going to talk here in a few minutes, give you reasons why the stock market could be higher at the end of the year. One of the things I want to talk about too, and I've talked about this in the past, is price to earnings, which this is how people value stock. It's the stock price divided by the earnings. Really looking back, here I'm going to go between these slides here a little bit. A year ago, this price to earnings ratio was about 35 for the S&P 500. If you take the S&P 500 as a whole. Today, it's dropped down to 22 on a trailing basis, a little out of order. The S&P 500 long-term average is about 17, so it's still a little overvalued. But if you look at this equation, and I think I gave the example of Google, because if you look at Google last year, it had a really good year. What happened is its price to earnings actually dropped, even as the price went higher because the earnings grew along with it. What we're running into now, and that's why we're in the middle of what they call earnings season for the second quarter, is there's a lot of eyes on earnings, especially this week, a lot of these big tech companies, to see if earnings continue to grow or they're expected to actually drop. So even though our price to earnings is in line with historical averages, which doesn't necessarily mean it's overvalued or undervalued, it's right in line. If earnings do drop, it could mean that our price to earnings actually moves higher. Seems a little odd. It's actually not a good sign for the broader market. So we're hoping that these earnings actually do increase. These are predictions from earlier this year. I left the top lines here. I updated some of these numbers just to show where things are in comparison to historical averages. Small caps had a very difficult year so far, but it's trading very cheaply on a price to earnings basis. I still think small caps, especially if we recover, are going to outperform large caps. If I say it enough times, eventually it's bound to happen. It's like those people that predict recessions. I told you there's going to be a recession. Yeah, you've been saying it for 5 years. Timing's everything in the market. In our outlook too, so previously where we were at, we look at GDP growth. If GDP, gross domestic product growth, was negative in the first quarter of this year. A recession is defined as 2 quarters of negative GDP growth. The second quarter, the preliminary number gets reported Thursday of this week. So that would be our 2 quarters if it's expected to be negative. However, there's a lot of caveats with this, is that once a year, these numbers are updated and revised. So there's a chance the first quarter GDP numbers could be revised to be positive. The other part of this to remember is that they look at it on both a nominal and a real term. So nominal is, what the actual dollar value is. Real is taking out inflation. So it's the real number that gets reported. So on a nominal basis, and the same goes for retail sales, on a nominal basis, things are growing. There's more spending, but when you strip out inflation, so on a real basis, it's negative. And that's why retail sales, that arrow's kind of just flat. We saw some numbers. Target, for example, showed that retail sales are down a little bit, but it's really, there's a lot of numbers, kind of, I wouldn't call it manipulation. You really have to dig into them to see what's happening. And one of the examples is when retail sales are reported, they look at things such as auto sales. And auto sales, I don't know if anybody here has bought a car, been car shopping lately. I guess I have myself, I guess car prices are just astronomically insane. So any car prices are really making that number look a lot higher. You strip those numbers out and retail sales are fairly flat, especially when you do account for inflation. Consumer confidence has been somewhat resilient. What's happened, though, is future expectations have really started to drop, especially when it comes to inflation. So consumers, when they're surveyed, would say that their expectations going forward are somewhat negative as far as the money that they're going to spend. And it makes sense. With gas prices being higher, people need to spend money on the essentials. So, heating, cooling their house, gas for the car to get to work, for example, not even recreational purposes, food. So there's been a lot of food inflation. And so that's hurt consumer confidence, and consumer confidence is about 70%, or the consumer spending, I should say, is about 70% of GDP growth. So that's why there's a lot of attention paid to that. What has been surprising is the job market. Unemployment remains at about 3.6%, give or take. So it's job market's really good. And that's, they're talking a lot, they'll get out with these GDP numbers this week. They're talking a lot about whether or not this really is a recession, and people analyze the numbers, and there's going to be arguments that yes, it is, no, it isn't. Maybe the number's positive and it's a moot point. But one of the reasons this wouldn't be a recession is because employment does remain fairly strong. People that want to have a job can have one and work. And then inflation, obviously, I think we all know what's happened there, is it's continued to move a lot higher. Just real quick where we are with inflation. These are the numbers from last month that came out, 9.1% year over year consumer. The core, so they take out food and energy because they're supposed to be more volatile. The Federal Reserve finally came out and said that everybody uses food, everybody uses energy, so it's kind of silly to strip that out. The wholesale producer inflation, 11.3%, so that's at the wholesale level, the raw materials before something's manufactured and sold to consumers. That tends to lead the CPI number, so seeing that 11.3 is not a good omen for CPI going forward. The CPI is a basket of goods. This is how it's broken down as measured by the government. What I want to stress, though, is for most people, their individual inflation number is quite a bit different. It depends what you spend your money on. So it could be a lot higher, it could be a lot lower. You'll notice that energy is not a direct component of CPI. It's figured in as part of housing. Natural gas, for example, to heat a home. It's also part of transportation. But housing makes up the biggest part. They do something called owner's equivalent rent. So they take a house, say, okay, it's worth X, here's what the rent would be, then they measure it year to year. So certain aspects of inflation, such as energy and food, are real volatile and can change quite a bit year to year. But then there's other components of it that they consider to be sticky. And that's things such as rent. If you're a landlord, you're probably not very likely to drop your rent. So on a year over year basis, that's going to stick and stay where it is. So there's a lot of components here that even if prices do start to drop or moderate, they probably will not be coming back down. I'm going to take a quick break because I've been talking a lot. And are there any questions, comments? Yeah.
I have a question. I've been reading about the whole auto thing because I'd love to buy a new car, and I was telling everybody I'm not going to pay $4,000 over sticker price to get a car in the color I don't want because there's not much available. But in my research, I saw that car repossessions for used cars are going to hit an all-time high before 2023. It's at 1.8 million. It's never climbed as fast. And the reason they're stating is because of all this inflation. First of all, they qualified for these cars during COVID when they were getting these government payments, and the banking industry and the car industry let them take that into consideration for their salary. So it was really a phony salary. Yeah. But as things go forward and inflation happened after they spent $8,000 for a $6,000 used car, because it was so hard to get. Now they're letting them go by the hundreds of thousands because they said it's essentially the same thing as the housing crash. Mm-hmm. Because banks are passing this paper around for these loans. It's like musical chairs, and the music's going to stop sooner or later, and somebody's going to be stuck with that paper. And somebody had one of the guys that was watching. I just was curious to your thoughts on this. Is somebody said, well, how about housing? Is that going to happen again? And he said, well, no, because people have too much skin in the game because there's been so much appreciation. You're not going to let your house go if you had $100,000 worth of appreciation in the last 2 or 3 years.
No, what it's done with housing is just pretty much stopped them from buying right now because it's really easy to buy when you can get a loan for 2 or 3%. Right now, with when they upped it by 0.75%, it looks like it's going to be 1% this next time. Then suddenly you can't afford the prices that are out there. So the market for housing is pretty much like dead in the water right now until things sort of settle out.
Yeah, and I didn't do anything on how. I actually did a lot of research on housing. I didn't do any slides, but I'm glad to talk about it for a minute because there's so many fascinating numbers, and that's with the cars too. I happen to see that same article that they are talking about a lot of repossessions, which really should, I don't want to say crush, but bring prices lower because those things are going to flood the market. They're going to get repossessed and resold, and if there's a lot of them on the market, then it's simple supply and demand. Housing's a little different though too, and our issue with housing now is, if you think about it, it is simple math. Interest rates, the 30-year mortgage rate now is 5.5, 5.75, fluctuates week to week. Where a year ago it was 2.5 to 3. Year ago, 2.5 to 3%. The other problem is housing prices have gone up so much that the payment on, when people buy a house, they don't look at the total dollar amount. They look at the payment amount. They're buying the payment, but these payment prices have more or less doubled with higher interest rates, and then with what housing prices have done. And if you look, existing home sales have dropped off a cliff the last few months, and there's a lot of reports of people dropping prices. A year ago, you put your house up for sale, there'd be this bidding war. That's not happening anymore. Those bidding wars have stopped. People are dropping prices, all over the place. They talk about some of these metro areas, Boise. There's 3 or 4. Was it Boise, Denver, Las Vegas, or something, where it's like 60% of the houses for sale are dropping their prices. But I think, to your point too, people do. There's a lot more skin in the game, a lot more equity. I think the underwriting standards have been a lot better the last few years compared to 2008.
Yeah, my point was that they're not going to let them go for the most part.
Yeah.
If you have the house, which really caused the snowball of the housing thing when people said, I'm not paying for that. I owe $400,000 on a $350,000 house, I'm out. You know,
Yeah.
and where they won't be dropping them anyway. They'll more likely suffer the percentage decrease
Mm-hmm.
and just kind of lump it because would be in their best interest.
Yeah, I think so. And what we've seen too is people, and a couple of years ago, COVID moved up. So they looked at their house and said, hey, this is worth a lot. I can get some equity out. I can roll that over at a low interest rate into a bigger house, moved into the bigger, and then that bigger house appreciated in price. So they have a lot of equity in most cases, enough to sustain even if there is a bit of a drop, I would think.
Well, the other thing that I think, going back to cars and stuff like that, the other thing that I'm thinking about is because of the talk of a lot of people working from home and stuff like that, which certainly happened during COVID and everything like that, you have a whole bunch of leased cars that started coming in the market and everything. Because I know my wife got a message from the dealership where she bought her car, wanting to, you know, come trade in your car and get this car that just came off lease, 2018, same version and stuff like that. And the price is about 25,000 net, which, you know, that's not giving me a whole bunch of credit for the car she has,
Right.
you know. But that's what they have. But you think about it, there's a lot of leased cars that are coming back if they haven't already because they bought them when they bought new cars.
Yeah. This one opinion I saw said the banks were intentionally releasing these cars slowly because they know it's a problem. It's a looming problem, and right now you're paying too much for a used car. They're still inflated, so they're trying to kind of slip them out without putting 500 of them on the market for a bank chain or whatever. But they're releasing and trying to get as much as they can for as long as they can.
Yeah, because
they were pretty dire, the banks that are into car loans anyway, and not everybody is, but they thought that it could be pretty devastating, you know, on par with the 2008 housing problem as opposed to cars.
Cars generally, up till a few years ago, are a depreciating asset for the most part too. So you buy one, you drive it off the lot, it loses 25% of the value, and
That's why I bought these cars. Leasing, I let the dealership take 20%.
Yeah, that's what I've done too, and just get a low mileage one, still has some warranty on it.
Yeah, get a certified Honda or Lexus or whatever, and you know.
Yep. So you don't have to worry about that.
A little bit of money, they'll give you an extended warranty or something.
Yep. So moving on, talking about the Federal Reserve a little bit, because it's driving the market. To a certain extent, this is the outlook previous, and this isn't necessarily, I guess you could call it my prediction. This is kind of the consensus at the beginning of the year. Talked about ending the monthly bond buying program known as quantitative easing in March. $120 billion per month that the Fed was going out buying bonds. That happened. They actually quit in March. At the time, beginning of the year, current forecasts call for 3 interest rate hikes in 2022, each 0.25%. We blew through that a long time ago. So, I mean, that just shows, you know, we can sit here, we can talk about what an outlook is, our predictions. It's subject to change dramatically, one way or another. So, yeah, that's the Family Feud X's. So we began in March, 25 basis points. May did 50. Back June did 75. Expected to do 75 again this week.
They backed off to 1%.
They did back off. Decided to a little bit. Some of the other economic numbers have come in a little bit softer, so they're gonna. That's one of the reasons we've seen the market do all right the last week or so.
Well, I figured that the 1% really wouldn't be bad. If anything else, what it would do is it's going to slow down some of the things that are just overheated.
There's a lot of people that think it's better, kind of like ripping off the Band-Aid. The Fed ought to go out, and if you look at it, so inflation's at 9%. Federal funds rate today, we're sitting at, you know, the upper bound is 1.75. There's a huge gap. So they need to balance it out. So it'd be better for them to go out and just they just worried what that might do to the
Yeah, and
market and the
the
economy.
thing about it is that right now, I'm happy if the market just stays relatively flat for the rest of the year. Let's get inflation under control, because that's really going to have an effect on more people than what we have there. And we're not seeing the kind of loans we saw down 2008 where everything was, get a low rate and then, 3 to 5 years, it jumps up by 5 points. Most of the stuff has been either been fixed rate loans.
It has, yeah, versus the ARMs that they were doing back then. So what's happened is the Fed began what they call a quantitative tightening program in June. So instead of buying bonds, they're selling bonds to take money out of the system. But they're at $47.5 billion per month. Remember their program, the quantitative easing, was $120 billion. So they've gotten pretty soft on this. We'll come back to that in a second. Current expectations, and these are subject to change daily, weekly, whatever. We are looking at a 3/4 point interest rate hike this week, looking for a 1/2 point hike in September, 1/2 point in November. As of now, December looks like nothing. That would take us up to a range 3.25 to 3.5, 3.5 on the upper limit for Fed funds rate at the end of the year. There's kind of some speculation. Okay, are they going to have to do more, or there's even a possibility that maybe they do less? Where there's a real mismatch, though, is what the Fed's projecting out into 2023 and beyond, and what the market's projecting. The Fed's projecting that they'll get to this point and probably have to stop. But remember before what I said is that we expected 3 this year, 3/4 point, and we've blown through that. If you look at the bond market, we'll talk about this a little bit more in a second, they're looking at the Fed lowering rates next year, probably as early as March, by 1/2 to 3/4%. Because what they think is going to happen is that the Fed raising rates is going to push us into a recession. I guess the silver lining in this is the Fed actually has room to work now compared to the past when interest rates were at 0. That's why they were buying so many bonds. That's the only tool left in their arsenal, was to flood the system with money by buying bonds. Now that they actually have interest rates off of 0, if they need to, they can lower them again.
Where are they going to get the money to pay the interest on the bonds?
Well, and that's another question. Yeah, the question is where are they going to get the money to pay the interest? Because if you think about it, before interest was next to nothing, this would be the government. This is more the federal government versus the Fed. The Federal Reserve is buying the government bonds. If you think about the cost and the amount of debt that the U.S. government has now, this is huge. So they say the Fed's not politicized. It kind of has to be, because they have a motive to keep interest rates as low as possible.
I just watched an interview with Art Laffer, which went through this in the 80s, and they were asking him, what would you do? And he said, well, first of all, during the last election, every conservative candidate came to him for the blessing on his plan, what he would do. And he was saying, there's no easy way out of this. You're going to have much higher rates, or you're going to have much higher production. You either have to increase people's ability to spend or to get the prices down. Production has to increase. You have the supply of goods, so there's more competition there. So he actually said every time taxes have been lowered, production has increased and has driven prices down. And then he said there's this dance you have to do with raising because as you remember, we bought a house in 1980 and the interest rate, I think, was 16. We didn't pay that, we assumed a mortgage, but I think it was 16 or 17%. And that was the only way to tame that kind of inflation, and that's kind of what we have now. So it's a really serious problem, but I don't think anybody really wants to deal with seriously.
Well, they don't. Paul Volcker came in the early 80s, and he had no problem hiking interest rates. And they say that in today's current environment, Jerome Powell probably doesn't have the guts to do it, and he should.
He had the president behind him to do it.
Right. Yeah. Reagan said it was all right.
That's what you had to have.
Yeah. That's what they said, that this rates now are determined politically, not economically.
I think there's a lot of truth to that too. And you can see that. So this is the Fed's balance sheet. So they buy these bonds, they keep them on their balance sheet. Is there a way to control the money supply? So if everybody remembers back in 2008, the great financial crisis, things were falling apart. The Fed stepped in, said, we're going to bail everybody out. Everybody said, that's crazy. The Fed doesn't need this stuff. That's back here. This is where we are now. The Fed's taken on so much more. If you look at what they did during the pandemic compared to 2008, they flooded the system with so much more, then it's no wonder we have inflation like we do today. So you can see up here where they were buying bonds, buying bonds to flood system. I took this a little bit closer in, so this just goes back a year. You can see that they have started to reduce their balance sheet a little. It's a drop in the bucket. They're being very accommodative in a lot of ways still with what they're doing. I always show the teeter-totter, bond prices versus bond yields. I like watching the bond market. I think the bond market tells us so much more than the stock market. I don't know if bond people are just that much smarter than stock people. Stock people are just gamblers and speculators, a bunch of degenerates, or if these bond people are really intellectuals, or what it is. This is what they call the yield curve. So it's just a chart of bond yields. The yellow line is where we were a year ago. The blue one is where we are now. This has a month and a week ago. This is from FactSet. I didn't give them credit. I should have here. So basically look at the blue line and you can see how much interest rates have come up in the last year. It's no surprise, but they've come up most here on the shorter end. You can see that it's what we call inverted, where our 2-year yield is higher than our 10-year yield. That's a problem. That generally foretells a recession. And you can see it here. So this chart comes from the Federal Reserve. So this dark black line is the zero. So this is the difference between the 10-year yield and the 2-year yield. So anytime it's below zero, it shows that there's an inversion. The 2-year yield is higher than the 10-year. These shadings are recessions. You can see historically, doesn't mean it has to be, but historically speaking, it's been a pretty good indicator of when recessions are going to hit. And we are inverted right now. We'll call it 20 basis points, give or take, maybe 25. So it seems to be foretelling a recession. You can tell it tends to be anywhere from, 6 months, year, maybe up to 18 months before. So the bond market's really flashing some dire signals. The other number that people are looking at is the difference between a 3-month treasury and a 10-year, which you're like, what the heck? And if you look at it there, it's a 6-month. So the 3-year is a little bit lower than the 10-year, but it doesn't move as quickly. But with the Fed raising rates, which that's pretty much been priced in for this most recent or this upcoming one, which we expect to happen this week. But after that, we're going to see the 3-year or 3-month move quite a bit. That's really a good indication of a recession. And so all things being where they are now, it looks very probable. The big question here is the 10-year, and you can see from a month ago, which is we'll call it purplish line, the top one there, the 10-year interest rates at the longer end really spiked in June. And that's because there was a lot of fear over inflation. And what's happened, it gets back to these bond guys being kind of smart, is it looks like things are looking better and there's going to be fewer interest rate hikes is what they're counting on now compared to what they were thinking a month ago. So therefore, interest rates at the longer end, so our 5, 10-year, 30-year have come down a bit. And so this is really what we're keeping our eye on. If we do start to see those interest rates move higher, that would change our outlook. Yeah.
Well, one of the things I keep thinking about is all of that backlog of goods and stuff like that that's on the West Coast, stuff that we still haven't gotten in 2 years, 3 years into the pandemic.
Mm-hmm.
And, that's going to fuel inflation until we can get, goods going out here and everything like this. I mean, you go in here and you have truckers that are having to, pay astronomical prices for diesel fuel, and now they're doing just like what the airlines have done, surcharges on for fuel.
Right.
And then you have a mismatch because you have your independent truckers versus the ones that are working for a company, and then they're not, the drivers or even are talking about striking for the ones that are working for companies because they're not making hardly anything.
Yeah, and so that is, and so we're getting back, and if we look at, that's the supply part of this. So your supply, and then there's the demand. And when the Fed raises rates, they're going to bring down demand, but they can't control supply. That includes things such as energy. Yeah, a lot of these bottlenecks. I did see a number this morning, and again, I can't remember where it came from, so I wish I could source it. It said that freight costs for the ships, the container freight costs have come down 50% in the last 3 months or so, which is it just shows that there's more of those out there able to transport goods. But then it goes on though, and it says that the cost today is still 4 times what it was at the onset of the pandemic. So it's.
This question is how many are sitting off the West Coast?
Yeah, and I don't know because they
still sitting in Asia waiting.
Because they used to show those pictures like the port of Long Beach with all the ships anchored waiting to come in. I haven't.
Oakland and Long Beach.
Yeah, I haven't seen. Politics, this is kind of the outlook. Talk about a red wave and November congressional elections. This really hasn't changed much. It does look like the polls are maybe moving more towards the Democrats slightly, not necessarily to favor them, but maybe the GOP taking fewer seats than thought before. That's obviously a very fluid situation and a lot could change. One thing I came across this is that midterm election years tend to be very volatile in the market for whatever reason. The markets don't like uncertainty. Same can be said for presidential elections. It's not necessarily that they favor one party over another, but they just don't like the uncertainty. So in an average midterm election year, the market drops 16%. So our 21% drop isn't that much further off. But a year later, the average return after the low date is 37% gain. So really, taking out, there's a lot going on in the world, in the economy today, but if you forget about that for a second, the fluctuations in the market this year aren't that far out of the ordinary for a midterm election year. Employment, we were talking about employment a few minutes ago. One thing we're keeping our eye on, unemployment remains very low, but our employment, or there's another chart here, which I don't have, the labor force participation rate, number of people working that can be working. If you look at this, so this is the employment to population ratio, there's fewer people working as a percentage of the overall population than there were pre-pandemic. So that's part of the problem with the employment today is fewer people are working. There's a lot of jobs. Job openings remain at their highest levels historically. I don't know what these people are doing with inflation like it is. I don't know if mom and dad are supporting them, or I used to have this theory that there was all sorts of people out buying Bitcoin that had made a ton of money and didn't need to work. Maybe they cashed out, or if
They didn't cash out.
they're broke now.
They did a dishwashing job.
Yes, ma'am.
So does your labor participation rate, do you have any data on breakdown by age? Because that would help to, the
Right, to the look.
that you have, like, is this people who made money on Bitcoin? I mean, we all probably have heard and seen too that there was a rush for retirements. And of course, latest with inflation, some of the retirees are thinking about doing some of those part-time jobs or whatever.
Mm-hmm.
So do you have anything by age for the labor participation rate and who they think which age categories represent that lower labor participation rate?
Yeah, that's a great question. And the question was, which demographic groups are represented by the lower labor participation rates? I don't off the top of my head. This, if you're bored, this is Fred. This is the St. Louis Federal Reserve, and they have all sorts of graphs, and they break it down by age, ethnicity. I should know all these things. The one I was looking at over the weekend doing a little bit of research is I was looking longer term. The labor force participation for men has come down significantly from where it was 30, 40, 50 years ago. For women, it's increased significantly. If you think back 50 years ago, a lot of times women stayed at home. I'm not trying to be sexist. I'm just saying this is what happened. Women stayed at home, didn't work, raised a family. Now, especially with the cost of things, it's very difficult not to have two incomes in a family. So we've seen the labor force participation by women increase a lot, while for males it decreases. For the age groups, I hate to say it, I think that the younger age group, though you're like 19 to 34-year-olds, that labor force participation rate has come down quite a bit too. It's lower. I know at one point the participation rate for blacks was higher. I think that census pulled back in the last couple of years though too.
They also talked about Hispanics coming down, I think, a couple articles I've seen.
Yeah, and I hate to say anything, but and I should know this stuff, but
Well, I think a lot of that has to do with too, like still the pandemic, effects of the pandemic, because those industries that were really totally shut down, like the hospitality industry and food, that includes food, hotels, all that. Many of the employees were in the minority populations.
right.
So they experienced the effects of those layoffs at a greater level, and perhaps they found alternative means to sustain their families or themselves and aren't quite back in yet. I mean, you can speculate but is this data all on actual employment data? I mean, not self-employment or.
Right, so.
Yeah, it's employment through the Department of Labor, right?
Yeah, yep.
Okay.
The reports that come out every month, there's
Correct.
the payroll reports where they're looking at actual payrolls. There's also the household survey where they're calling people up. Are you employed? Yes, no.
Yeah.
And so it does get a little goofy. Like they talk about the gig economy where maybe people are they don't have a job, but they're doing software development on a contract basis, or they're driving Uber.
Exactly, and that wouldn't be reflected in here at all.
Right. Another chart, I showed this at the beginning of the year, and it's just gotten worse. This is actually for what they call production employees, so non-supervisory, non-management. The blue line shows what we would call the nominal wage growth. This goes back to 2015. This right here is 0 if you can. So this is basically hugging the 0 line right there. The green line is on a real basis or inflation adjusted basis. Over the past year, wages have gone up on a nominal basis 6% for these types of workers. On a real after inflation basis, it's dropped by 3%, which is no surprise. And this happens to be just for the production workers. I think the same is true for most workers. Even, we've seen wage increases, but they're not keeping up with inflation. So it makes it much more difficult for most people to sustain some of their spending like we've been talking about, especially on the discretionary basis. We've talked about recession quite a bit. And we'll find out this week if we're in one. I'm sure there's going to be some argument one way or another when they look at nominal versus real numbers. How does the stock market do in a recession? And a lot of times the stock market will, if you look at it, the stock market bottoms in the middle of the recession, or sometimes even beforehand, but you normally don't know you're in a recession until after the fact, where you look back. And if you remember 2020 with the pandemic, there was the shortest recession in history, but nobody knew about it till I think we knew, until we looked back and said, hey, it actually happened. But if we go back to 1948, just some statistics, history doesn't always repeat itself. The average stock market pullback was 29%, but the median is 24%. We've pulled back 24%, so we're kind of in line. And if you look at what I would consider, if we are in a recession, this doesn't seem to be a very deep one so far. Now, obviously things can change, but GDP growth being negative, we're talking tenths of percent. It's pretty small. And then the average return 1 year after the low is 40% too. So if we are in a recession, which we could be, we maybe have seen the worst of it in the stock market. These are some of the remaining questions. Are we in a recession now? Is there a lot of larger investment banks are calling for one in 2023 or 2024, which is quite a ways out. They just think that the Federal Reserve is so far behind the curve, so to speak, with raising rates. They got a late start. They waited too long, that now they have to play catch up, and they're going to have to raise rates faster and more than they thought previously. And what they'll probably do is even overshoot it. They started late, and they'll probably end late, even after the data maybe shows them otherwise. That's why they're predicting recessions down the road. It could possibly be good news, especially on an inflationary front. If we get a very soft recession that hopefully doesn't affect employment at all, recessions tend to be deflationary. If there is lower employment, people aren't out spending money. There's It comes down to consumer confidence. They're worried about what's happening in the economy. So recessions generally are not good, but some aspects of it might be welcome. Inflation, are we at peak inflation yet? They keep talking about peak inflation so the numbers that they release every month it's a year-over-year change compared to a year ago, and they keep going up. So our rate of inflation seems to be increasing. For those of you that actually read my weekly out there, I thought that this past release might have dropped a little bit, surprise to the downside. I think I was a month early. A lot of it has to do with timing. If you look, like I was talking, a lot of the commodity prices, energy prices dropped. So I think next month it might even come in a little bit softer. Does that mean we're at peak inflation? I don't know. And if you look at where we were a year ago, so we're looking back to last year, July, August, energy prices were still pretty low. We really didn't see the big energy spike until kind of the Russia-Ukraine thing earlier this year in February. So I think we're going to see very elevated inflation at least through the end of this year. And when I say elevated, I'm talking 6-7%, most likely. A lot of it being housing, which is sticky, kind of the same thing. Housing prices, owner's equivalent rent, were increasing last year, but I think we saw really an increase in that earlier this year. So I think we're going to see inflation through the end of this year, probably into the early part of next year.
Well, the governments have a vested interest in having the housing prices stay high so they get their higher property taxes.
Oh, yeah. All these counties are loving this. I'm sure they are. So as far as the stock market, is the bad news priced in already? I don't know. I'm always an optimist. If we look at the market kind of bottom in the middle of June, I remember sitting in this room with Joe Lucy right around Memorial Day, and we were taking bets. I'm like, the S&P 500 is going to be higher by Labor Day. I guess we don't know yet. And there's a bunch of other people that saw it in the middle of June. They came to me and told me I was an idiot, but I don't know, might pan out. I do think, looking at everything going on, obviously inflation is the big thing. We do have slowing economic growth. We're worried about earnings. But, the market's pulled back so much that if it could very well drop. There's no doubt it's going to be volatile, but I wouldn't be surprised if it does start to move the other direction. And some people have compared it to a loaded spring, where once it goes, it really goes. And if you look back to 2020, that's kind of what happened. I don't think that's going to happen. And if you look at some of these stocks, there's a certain amount of selectiveness. A lot of these stocks have been beat up so much. And if you look at them, they're still good quality companies trading very cheaply. They're still making money. Their earnings are increasing. And I think they're going to do well. Then there's some of I get back to the profitless tech stocks that, have not done very well. I mean, their stock prices are down 60, 70, 80%. And that's probably well warranted. They need to mature, actually have positive earnings, positive cash flow in order to do all right. And some will probably do okay. Others may not make it. And if I look at the environment, it's very similar to back 2000, 2001. There was a lot of tech companies. Some survived and done very well. Amazon is a great example. Some of these stocks, though, it took them 10, 12 years to recover to a point where they were higher than they were previously. Some of the stocks simply didn't survive, went out of business, were bought because they're beat up so much. There's stocks out there today still trading that still are not at the same levels that they were in 2001. And I think that we might see some of that today with a lot of these. There's a lot of tech companies out there, and they do great things. A lot of cloud computing is one that comes to mind. They're just not making any money yet, and they might at some point. There might be some consolidation. So as far as the market goes, I think some stocks will do well over the next year, but I don't think all. It's just my guess, especially going into the end of the year. I do think that the stock market will be higher at the end of the year compared to where it is today. Doesn't necessarily it's going to be positive on the year, though. We have a big hill to climb there. And we've talked about real estate and housing quite a bit, and then employment. And employment really seems to be the bright spot in the economy today. And unless that changes, the problem is there's a lot of wage pressure. People want more money, obviously. We showed they want to be able to keep up with inflation. I saw a number, again, over the weekend that talked about, historically speaking, when people stay at a job, they get consistent raises. Then if they switch jobs, sometimes they get a little higher raise than they would otherwise. That's why people tend to switch jobs. Makes sense. But the difference between the two right now is the greatest that it's been because the labor market's so tight. that people are getting more money. The problem is these companies have to pay up for it, and it's just adding to inflation. Multi-year outlook, I show this, when we're investing in stocks, we really want to look at the big picture, where we're going to be in 5 years, 7 years. I still think that there's a lot of strength in technology, a lot of innovation. That's one reason why, if we look at bear markets, recessions, I think the economic cycle is much faster now than it was 10, 20 years ago, because of a lot of the technology and innovation going on. That's why I expect us to climb out of this bear market faster than maybe what we've seen in the past. I've always been a fan of emerging markets. There's very favorable demographics, rise of the middle class, especially when you look to India and China. Some of the other emerging markets have maybe already gotten there, but you look to certain parts of Asia. The risk, though, with this is the government and the politics. We see that especially with China. We've seen it in Eastern Europe. El Salvador did some crazy stuff where they loaded up on Bitcoin as a government, which right at the top. And so that's one reason to kind of give pause. So you have to be very selective there.
I hate to call us an emerging market in the U.S., but you think about the government and politics, that's going to play a big play in here in the U.S. and the stock market and stuff like that.
Absolutely, yeah. And then I think there's going to be a normalization of inflation and bond yields. I was talking before about the Fed does their projections. You look at the markets and their projections. In all of them, if we go out to 2024 or so, are kind of looking at about the same point, Fed funds rate of about 2.5%, and more what we call more normal bond yields. And inflation, historically speaking, that inflation's 2 to 3%. Might take us some time, but that's probably where we're going to end up. Yeah, I think we've talked a lot about this. The growth is stagnant. I'm not as optimistic as I was before. Growth in earnings, growth in GDP could be negative, slightly negative. If it is positive, it's slightly positive. It's not a real rosy outlook there, but hopefully you can stick together. And then the equity markets, I do think it'll be higher by the end of the year, but when I say higher, I mean compared to today or the lows. I don't necessarily mean January 1st of last year. And then I do think the returns will vary by sector and individual companies as well. So yeah, that's all that I have. Are there any other questions? I've gone extremely long, and I apologize. So thank you all for bearing with me. I don't know if there's any.
We had a few questions. That's good.
Yeah, that was good. I appreciate that.
Well, we know that come 2025, that likely that we'll see increases in tax rates and stuff like that. One of the things I did is I just finished reading Mr. Walker's book and things like that. It sounds like we got a lot of work to do in a lot of places to really get ourselves economically under control in the United States. If we don't, it's going to be even worse.
Yeah, that was kind of Art Laffer's take on this. He said this is the worst situation in my entire life. If you look at the intersections, the way that they're coming together between the economic speaking statistics, he said it's really never been like this. So really, to get out of this, you really have to be raising interest rates 2%, 3%, another 5%, to get it up, to get it under control. But he said there's no politician that's willing to do it. So it's just kick the can down the road. So he thought it would be more stagnant with a few dead cat bounces during the year. He said there's still going to be some stock market kind of mini rallies in there, but he thought that reality would eventually rear its ugly head. So I don't know what to expect, but he seemed a little frightened by the whole thing, actually. Kind of a Walker approach, actually.
Well, yeah.
It is, and it comes down to debt. I had the privilege of speaking with Mr. Walker when he was here for a bit too, and you look at our country's debt, and I showed you that chart with the Fed's balance sheet. Our debt looks very much the same. $30 trillion. It has to be paid for somehow. You can keep kicking that can down the road, but at some point you have to pay for it. And you know, you look at kind of the demographics too and stuff. There's got to be a point. And you know, you look at Japan as the other one too, where their debt is such a large percentage of their GDP, and we're not that far behind. It's going to really constrain our future growth.
One of the things that Walker's book pointed out is the difference between Japan and the United States is in Japan, most of that's held by the internal market of Japan, the Japanese consumer. And in the United States, after the Fed, you're talking about probably at least a third of it is held outside the United States.
Mm-hmm.
And to the point where a lot of the countries like China that was taking and buying a lot of our debt aren't any longer, and they're divesting.
Right. And what that does to interest rates, if they're not buying, yields have to go up, on prices have to drop. It's supply and demand. So that's scary what could happen to the bond market.
We think it's bad when they're not selling us chips for our cars, wait till they're not taking any of our debt. You know, I mean, they have us in it's kind of a Mexican standoff in a way, because they need us to buy their goods, and we need them to
That
pay their debt.
Yeah.
But all they would have to do is slow down on that for 6 months, and we would be asking what we could do for them.
Well, we need to do something for ourselves.
Yeah.
We need to stop spending.
Yes, that's not very popular.
No, it's not.
It's not, but it's reality.
No. I saw something, I wish I had the figures, they broke down the federal government, like if it was your household income, because they just took a bunch of zeros off, but essentially it was like, okay, you make $67,000 a year, you're spending $176,000 a year, and you have $456,000 on your credit card. That's kind of where we're at. So you know what your personal situation would turn out like if somebody allowed you to do that.
Right.
I mean, that's how out of whack it is.
Yeah, well, one of the things you look at, inflation and all this other stuff, makes you think about when Joe talks about mailbox income, having your mailbox income cover all of your bills and things like that.
Yeah,
and so that if the market goes down, you don't have to sell.
Yeah, exactly.
Or if you're selling, you're doing things like taking advantage of the lowest tax rates there to move stuff into tax-free versus tax-deferred.
Yeah, a lot of strategies there. That's times like this that present some opportunities for that too. So, all right, well, I can let y'all get on with your day. Thank you very much for coming. Enjoy the nice weather, a little cooler here. Good. Thank you so much. If there's ever questions, let me know.